alongside me is Richard Fairgrieve. He's a fund manager at Blackfriars Asset Management. Richard, thank you for coming in.
Morning,
all right,
Francine.
this is not too bad. I mean, it is slowing. We're still at double-digit growth, and actually it means that they can start spending. This is really the secret. The world needs China to spend, consumer to pick up, to get us out of this recession.
It definitely does. It remains to be seen, though, if China has enough firepower to lift up the world. The government really does need to refocus the economy from export-oriented to domestic spending and domestic consumption.
Is there any sign that they're trying to do? I mean, we see a little bit of flexibility on the yuan. There is a movement that actually wages are starting to rise. When are we going to see a definitive, go ahead and consume to the Chinese people?
Well, I think they're signaling it through such measures as you mentioned, wage rises, also increased spending domestically. They have announced a big stimulus package for the inner provinces like Sichuan and Inner Mongolia to get the economies there jump-started. They want to change the focus of the economy from the coastal export-led provinces to more inner, helping out more people, boosting living standards in the inner provinces.
But does, for example, this growth figure mean that they have to scale back restrictions on bank lending? Is that going to boost consumer spending?
I don't think they'll change the bank lending restrictions whatsoever. It's still going to be 7.5 trillion yuan this year, so quite a high and punching figure. Chinese banks tend to crowd their lending in the earlier part of the year so they can get the benefits for the loans they extend in January, February, March to their profits throughout the year. So with this number, it does show that obviously the economy is slowing, but most governments in the world would love to have 10% plus GDP growth.
Richard, Angela Merkel, the German chancellor, is going to China to try and win some contracts. We heard from Volkswagen, they're trying to increase their presence there. But you believe that actually for investors, China still remains a bit risky?
Well, it does from the sense of when you make investments in China, you have to look at who your partner is. And most of the big stocks, the CNOCs of this world, the China Mobile, the majority shareholder is the government. And the government will look first to see what benefits China and benefits the government, and then think about shareholders second.
So as an investor, how do you take, how careful do you have to be? How can you still take advantage of China's growth?
That's a very interesting question because it brings up, as I mentioned, the whole idea of having the government as a partner. You have to, and if you believe in domestic consumption story, you have to look at outside the bigger stocks to some of the smaller mid-cap stocks. That's been a very popular theme this year amongst investors. However, a lot of these stocks are sporting very pricey PEs now, 25, 30%, and they're priced for perfection. And if you have a disappointment, as say in the case of Skyworth Digital, which is a company that sells TVs to the Chinese consumer, that the stocks get pummeled. That stock has about half this year from its highs, over $10. It's trading at just over 5 Hong Kong dollars now.
What about investing in actually big American brands that want to grow their presence in China? Would that be a way to go about it?
That is, but you're not going to get the punch that you do get get from domestic Chinese brands. One other thing that Chinese really need to do, too, is housing. They've addressed the top end of the market. They're very worried about the price increases there, but it's getting housing to the masses, to the mass market. So, there is a real housing shortage in China, but it's at the lower end. So that's a way to think about playing increased Chinese consumer demand.
Richard, thank you so much. Great to speak to you.